The housing market, it's just status quo, or is it? Maybe we see some changes or some signs of changes coming up. We'll talk about that in a second. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 23rd of December. We are getting very, very close to the Christmas holiday season. So I wish everybody a Merry Christmas, Happy Hanukkah, Feliz Navidad, Happy Kwanzaa, whatever faith you subscribe to or what you practice or enjoy. Have a great holiday season. Haven't been doing videos for a while. It's been a few weeks, and I guess I need to catch up on that here. Again, Randy Patrick putting the realism back in real estate. Hope everyone's doing well. This is brought to you by our friends at Foreclosure.com. So if you're looking to find out the distressed property listings in your area, you just need to go to this website. It's gethousingdata.com. That's gethousingdata.com. That'll take you to the Foreclosure.com website, and basically, guess what? Look for distressed properties in your area. Why? Because there's some great deals to be had if you're looking for them. And what I want to do right now is kind of almost, you could say, debunk the mainstream media by saying, people who are facing foreclosure or forbearance, they'll just simply sell because they have all this equity and stuff. Well, we just closed on the short sale. Remember last video I said we have the closing coming up. Well, it did close, so we'll talk about that towards the end. But guess what? There's some pretty big numbers there, and it just goes to show that if you sort of figure out what's happening in the marketplace, knowing that we're in a managed housing sort of crash that's already kind of begun, and things are, I guess you say, the stuff's being laid out in front of us. It's going to start to happen in the new year. Again, there's still questions as to how it's all going to unravel itself, but my point though is that there really is some outstanding deals that could be had. So don't listen to the what I call the mainstream housing narrative, and I think I can't say that word anymore. I think that's a trigger word for us on the medium here, so I can't really use that on a going forward basis. So we'll call it the current housing story. All right. So what happened yesterday, because it was the 22nd of December, NAR, National Association of Realtors, releases their existing home sales report for the previous month. So we're in December, and they're talking about November 2021 housing existing home statistics. So ultimately, what you see here is that we had a I guess you could say existing home sales rose slightly from October. Seasonally adjusted rate at 6.46 mil. Median home price was up about 13, almost 14% to $353,900 as the median home price. And ultimately, in the end, the comments from NAR, Lawrence Yun, who's the chief economist, basically said determined buyers were able to land housing before mortgage rates rise. Future in the coming months, locking in a constant and firm mortgage payment motivated many. Locking in a constant and firm mortgage payment, I guess you could say, motivated many consumers who grew weary of escalating rents over the last year. Mortgage rates are projected to jump in 2022. However, I don't expect the imminent increase to be overly dramatic. Yun forecasts the 30-year fixed mortgage rates to average 3.7% by year end. So he's basically saying buying was up because people want to lock in their rates. They don't want to. They also don't want to rent anymore. So here we go. Let's get some. I guess you could say some. Something solid that we know we're going to have in the future. Supply chain disruptions for building new homes and labor shortages have hindered bringing more inventory to the market, he said. Therefore, housing prices continue to march higher due to the near record low supply levels. He did note that inflation and the pace of price appreciation is expected to subside next year. And ultimately, they're saying housing experts whose consensus found inflation would likely ease in 2022 at a 4% rate, while home prices are expected to rise at a moderate pace of 5.7%. Now, obviously, 5.7% is what they're saying, for a price rise, which is not double digits that we're used to, nor some of the locations around the country that are having, in the 20s and 30% double digit increases. So, and this is kind of, I guess you could say, what the real question is, that we've already seen signs that stuff is slowing down. It's just how much, how far, and what do the things that affect real estate, how does it impact home price appreciation, and whether we're going to see some price decreases on a going forward basis into the new year. So Let's talk about that right now. Let's get into the NAR stuff. So if we take a look at their summary of their existing home statistics, they put this out every month. And this, again, is based on existing home sales for the previous month. So at the run rate in November, the annualized, so seasonally annual adjusted rate is 6.46 million homes. So they typically basically use this as, here's how many homes will be sold over the course of 12 months. That's based on the current month's run rate. So you can see where it's dipped during the pandemic, and you can see where it has gone up now with some of the recovery that we're having. So they're looking at 6.46 mil run rate of homes. Do we have enough supply? Probably not. Well, we know we don't. Our annual, median price. So median price this month was $353,900, a little bit less than the previous high a couple months ago. But when we take a look at where that was comparing year over year, it's about 13.9% higher than it was the previous year. So you can see where we saw the big jumps in price appreciation was the May and June and July, and then everything kind of slowed down. Once August hit, we had some dips dips mean still double digit, but 12.7, 12.7, now 13.9. And typically as we go into the fall, things slow down. As we get into what I would call the holiday season, the holiday months, like people are off the week of Thanksgiving, people are going to be off part of the the Christmas holiday week, etc. We traditionally have seen a slowdown in sales. What he basically was saying is that we didn't see the slowdown. We actually saw a slight increase. And again, maybe there's some extra motivation from people out there to get their hands on property and purchase. So a little bit of an uptick there for existing homes. But still, the overall the rate of homes or number of homes are decreasing just because the sales volume is down because of lack of inventory. So we can see that once kind of, August hit, we've been, the year over year number of homes sold has been less every month, including up to November here. So less homes sold, but homes sold for more money than the previous year. All right, previous month last year. Realtor Confidence Index Survey. We talk about this just because it kind of shows where things are at. So obviously the darker shading of the kind of like orangey pink there is the current month for this year, November 21st, 2021, and November 20 is the lighter shade, so it's a comparative bar chart here. So first-time home buyers, we saw less of the first-time home buyers in November. We saw a slight uptick in sales to investors in November. We saw a significant increase in cash sales in November. Now, cash sales are, a lot of investors are buying with cash. That helps that number as well too. But we know a lot of people are relocating from higher priced areas. They are cashing out in, the Northeast, the West, the Chicago area, whatever. They're getting good value for their properties. They can come down primarily to the southern areas where it's a little cheaper and buy cash and still keep money in their pocket. So that's kind of interesting. So we do see the cash sales up. Distressed sales, less than 1% for foreclosure or like REO, bank-owned foreclosed properties and short sales. So we'll talk about that as well in the future. And days on the market. So days on the market are, actively, you put something on the MLS, it sits on the market for how many days on average until it goes under contract. Well, days on market is 18 days to contract as opposed to 21 days. So certainly seeing some briskness happening in that part of the real estate market. So that's what the Real Estate Confidence Index says. Sales by price range. Well, this is a sort of anomaly, and we're seeing maybe not even anomaly anymore. We're seeing less distribution of sales are less and less every month on the lower tier and slowly increasing more in the high tier. So, the 100 sub 100K 4% of the market. Okay, where can you find $100,000 home under $100,000? Not many places anymore. All right, the 100 to 250K, which I call affordable housing, 24% of the market. 250 to 500K, 43%. That's kind of your average buyer. 500 to 750K, 16%. 750 to 1 mil, 6%, and 1 million above, 7%. So I know that the 750 and the 1 million and above are slowly increasing, and that's helping to drive some of the numbers that we're seeing right now. So you can just see distribution. So the percent change in sales from that pie chart year over year is kind of interesting. So obviously we're seeing almost 15% less sales in the low tier. almost 18.5% less sales in the 100 to 250 tier. Small increase, 6.9% at 250 to 500. Where we see the big jumps, obviously, is the 500K segment, the 750K segment, and the 1 million segment. So going back to people buying cash, going from higher price locations to other price locations, you can sell a $2 million home in New York and come and buy $1 million home in Florida, okay, and you're still up $1 million. So that's obviously, you can see those are significant increases. So as a result, when the median home price, I guess the distribution of sales, is becoming more and more. It's growing in the higher end. Therefore, your median home price will be dragged up with that number, as well as the average home price as well too. So just something to remind ourselves that we're seeing more, whether it's more wealth, better economy for certain people, or the fact that there's some relocation taking place and how that manifests out. You're selling at $2 million and coming down here to buy $1 million. Well, the person that bought your home for $2 million, do they think they got a deal, and what's going to happen to them in the future? So this is kind of the precursor to some of the shift, but it's interesting to see that there's a lot of interest in the higher priced properties, from relocation to Airbnb usage, whatever. So just that's something to always keep in mind here. So interesting. Oh, and by the way, if you're not a subscriber to my channel, please do me the great honor and smash that subscribe button. I'd really appreciate that. And if you are a subscriber, think you are, could you please double check and verify? Because every month I lose subscribers. I've been maintaining the same number for I don't know how long now. It just what comes on comes off, and as I said before, there's just shenanigans going on behind the scenes. So please resubscribe or subscribe, help my channel grow. Thank you very much. All right, so where are we at right now with a few things? So this is interesting. So obviously the Fed had their conferences about rates and stuff, and this is off from Mish Talk here. So I want to make sure that I'm crediting where the data comes from. So he basically he has a Fed Watch tool that basically the Fed's saying we're looking at maybe 3 rate increases in 2022, but I guess there's betting lines that are going on with this, the over/under line. So you can see that the bulk of the people are saying, we're going to see 3, if not 4, I guess you could say, rate increases in 2022. So that's pretty significant. And this is, again, it's just the small things. Individually, it's not that big a deal impacting the housing market, but when you start to add a number of things up that'll happen simultaneously over the course of the year that will overlap, that's where, we can see things changing, manifesting out, and whatever. So we've had no interest in rate increases for how many years now? We've basically had quantitative easing. And, that's allowed people to buy. That's allowed people to overbuy. That's allowed house price appreciation to go up. It's, the government, and a lot of economists have said that the government has misread the housing market. Maybe they've misread it, or maybe that's their ultimate plan behind the scenes. We don't know. I'm not even talking about it on this video here, but the government increased their FHA loan limits and what they're going to back it or underwrite, and it's a lot. They've increased significantly. So people they're encouraging people to buy. And by doing so, it's the policies they have in place. They think they're encouraging people to buy, getting renters out into first-time home buying by increasing loan rate, like keeping interest rates low, increasing the value of loans higher, so you can jump on those higher price and tier points. Does that help? Who knows? But we'll see how this plays out as the year goes on. And you can still see that, even though that 3 and 4 seems to be the number where I guess you could say everyone feels that the number of rate increases will happen. People are saying, hey, well, we could even see 5, 6, 7, 8 increases depending on how things play out next year. So looks to be a interesting and volatile new year. And again, it's all about how this is going to play out, keeping abreast of what's going on in the financial community. So I do think this is very interesting. Also, bidding wars ease up in November. So Redfin produces this bidding war data, and really it's just based on their data on their listings. So I don't know whether this is indicative on what's going across the country, etc. But bidding war dips below 60% for the first time in nearly a year. Now I know that Redfin is going to play in, or does play in. They don't play nationally; they play in specific markets across the country, and they play in obviously the bigger markets. So they may have what's going on in a tier 1 city like Atlanta may not be the same as what's maybe Birmingham, Alabama. Okay, who knows, right? I'm just using those as examples. So, but you can see that they've seen a dramatic decrease in bidding wars, and bidding wars are multiple contracts on their listings come down from a high of, I guess you could say, 74.6% in just this year, May, dropping below 60%. So that's significant, but again, how that plays out, who knows? It could just be a sign of the times. Could just be, again, people tend to slow down during the holiday season. Once November hits, real estate tends to slow down as well too. So I'm not reading much into this, but it may be, again, one more small thing that could contribute to what's going to happen in the future, which is interesting. Now, this is interesting though. Rent growth nearly triples as housing inventory tightens. So this is significant. So typically rent drags along. So house price appreciation goes up. And then, landlords realize that, okay, well, we can, if we're actually, if buyers are getting priced out, they remain renters, but they're better qualified renters, so we can raise rents now, you see. So rents typically drag and tag along, but they drag along a little bit. Well, now we're seeing rent, indices going up significantly and obviously almost like exponentially there. So rent growth has gone up. If we take a look, a little better picture here, a little closer to the you can see where it is in 2021. It's gone from an annual increase of probably around 3-4% to we're talking double digits now in pretty much all the tiers: low, middle, middle, high, and high tier. So there you go. Everyone's paying more for rent now, and that's a function of interest rates. It's also a function of cost profile for landlords and owners. Could it be a function of recovery from the eviction moratorium that's out there, that was out there, and it's still out there in certain locations across the country. Certain states do have some of it going on until partial into the new year. Some counties across the country still have their own as well too, like LA County, for example, New York State. Those areas still have some eviction moratorium going on. So is it a factor of landlords have to charge more now to recoup losses they've had over the past couple of years, and also just cost of living, right? Everything's going up. So we all know, we hear this constantly on supply chain and inflation. Well, it hits everywhere, and everything is passed on to the consumer, the owner, the renter, etc. So should not come as no surprise here. So that's a scoop on that. And just when we talk about it, to gain a detailed view of single-family rent prices. Again, this is single-family. This is not apartment complex where we're talking single-family homes. CoreLogic examined the 4 tiers of rental prices. So low tier up 9.5% from a 2.8% last year. Lower middle 10% up from 2.8. Higher middle price 11.3 up from 3%. Higher price 11.4 up from 3.5%. So we're not talking 2.8 or 3 to 5 or 6. We're going pretty much right into the double digits right away here. So that's the significant increase. That's, as I said, almost triple what you normally see on an annual basis, which to me, that's where things get kind of dicey. So we know home price appreciation is always at all-time highs. Difficult for people. We all know that. We're in bubble territory. As I say to people who comment here, going, it's every economist and analyst out there agrees that we're in a bubble, and everyone says the pace of home price appreciation is not sustainable. That's pretty much a global statement right here. What we don't agree upon, or what we don't know, is how it will play out. Will we have a crash? Will we have a crisis? Will it be regional? Will it be metro-based? So that's still kind of figuring its way out. I got my thoughts on that, and we'll talk about that when I do my next series on predictions for 2022. But it goes to show you that this is renters are getting hurt, but it's just eventually it has to pass its way down the chain from owners, landlords, renters, developers, investors, whatever, and now we're at the lowest common denominator, and now they've seen some significant increases, which is not particularly great for people when everything else is gas and food and everything else with supply chain and inflation's hitting you too. So it's tough to exist in today's inflationary economy for sure. For example, this surprised me, was about single-family rent change for certain geographical areas. We'll take a look at this. Miami, holy crap, 29.7%. So Miami's interesting because a lot of people there, and they always, when there's like condo issues or crashing, they crash hard, but then they also recover hard the other way, as you can see. So basically, year over year for rents was almost 30% in Miami. You got Phoenix next at 19.3, Vegas area 16.5, San Diego Diego, Dallas, Austin, Orlando, Kissimmee, 14.1%. The Atlanta area, 14%. Houston, 10%. So pretty much, there's growth going on there. Not every city that big cities represented here. I don't see the Tampa area here. So, and I know we're certainly greater than 4.2%. Year-over-year annual increase for sure, but just goes to show you the range of where we're at. So Chicago, nominal at 4.2, and Miami out of control at 29.7. So pretty big spread with respect to rent increases, and again prices too. Like other words, you can see that depending on where you're at, you can San Diego is 3,100 for a median rent. Whereas Houston or Charlotte are 1,600, 1,500. So there's such differences there across the country based on where you're located and what's available. So just goes to show that people are now getting hit with primarily double digit increase in rents. All right. Now, as I always mentioned, the shift has started, and it started when July 31st, when basically the federal foreclosure and eviction moratorium finally ended. Certain states opened up. We opened up down here completely in Florida. Other states kind of tagged along. There was a few little, we'll call it constraints still out there. And once the new year hits, pretty much all those constraints or moratoriums or I guess like we'll say pullbacks of filing foreclosures and stuff, they're pretty much all going to be gone across the board, except for maybe the one or two smaller locations, and maybe like some of the states that have like a California or New York that's going to have to be a part into January, or maybe not one or extra 2 months of their moratorium, but it's coming. Okay, so the shift has started. Things are already manifesting now. We're already seeing change in the marketplace, so it's the market's moving that way. Things are starting to shift in the other direction now. So as I mentioned, when we have one thing that happens that impacts the home price appreciation in the negative or opposite way, it's usually not enough to bring the market down. It's going to be a number of things that will happen. All right, we haven't even talked about this yet too. Home equity lines. Okay, that's becoming big again. People, we have record home price appreciation, so now we have record equity. So what do people do with record equity? Well, they can't help themselves. They tap into it with either cash out refis, so they can do rate and term, or just refi for rate and term, or if interest rates are low, or they can do cash out refi, which is both rate and term and pulling money out, or they can go down the other path, which is home equity, which ultimately is like a revolving credit facility on your property. So you can essentially go to your bank or credit union, whoever you bank with, and say, hey, I want to take an equity line on my home, and if you've got if you're better than 80% LTV, then they're going to give you something on that. So look, that's increasing to levels that were pre-last housing crisis levels, and I would imagine we'll see more of those, especially if interest rates go up. We'll probably see people start to tap into that equity as well. So that's something for the future. So as I said, things are starting to shift in the other direction now. And we'll go to this slide here, which I showed you guys early on in the video. I was waiting for it to come across here. So this is a short sale, all right? And this is what I would call a successful short sale. As a matter of fact, I would call it a very successful short sale. And the reason why I thought it was important to say that is that this really kind of debunks some of the things that people think about the marketplace, distressed property, whatever. So this is a central Tampa home, okay, that we did a short sale on. And, when we start taking a look at the numbers, it really shows that there's opportunities here. And that's what I'm trying to do, is to show people going, listen, you can, we're running two separate housing markets right now. We're running a retail market, and I've said this for the past couple of years, we're running a retail market, which is the housing story that goes on, and we're home price appreciation, low interest rates, buying, selling, low inventory. That's the retail market. But below the scene is we'll call the off market, the underground market, the shadow inventory. So these are homes that are in distress that aren't appearing on the normal market right now. They may in the future, they may not. That's part of the I guess you could say the game and the dance here is how to get your hands on these before hedge funds do, the lenders take them back, etc. That's part of the game plan. So this just closed. So the last video was going to close. Now we close. So we have some more finite numbers here. So it was a short sale. The total mortgage balance owed on this property was $340,000. That's principal. That's all the interest, late fees, attorney fees, blah blah blah. Typically, the number is called a final judgment. So just before it's set to go to foreclosure, they issue a final judgment number, and that's what's owed So if you wanted to buy the property and just buy it outright, you would have to bring that money to the table to pay everything off, and it's yours. Okay. Well, it was facing an imminent foreclosure sale. We were able to get that stopped, which is great. So we went, we have our methods to going to the lender saying, hey, we're a buyer here. We've got this set up. Now, please, on behalf of the homeowner, work with us, because a short sale is better than a foreclosure for 99% of the homeowners out there. All right. So we were able to negotiate a purchase price of $172,500. Okay. That's a pretty good number. And how good is that number? Well, it's a 49% discount off the mortgage. And I can tell you, our first, we'll call it first iteration with the lender, they came back and said, we want $300,000 for this. Well, the home is not worth $300,000. Okay. It does need some work on the inside. Okay. It's basically cosmetics. It wasn't worth $300,000. So, we have our methods and our techniques to push the value down. So the ARV is easily $350,000. As you can see, that's recently the Zillow number. That's the midpoint is $353,000, and the value range is $332,000 to $375,000. So if you fix this baby up, you can get, you're in that $370,000. That's a pretty good number here. So I just used the middle $350,000 to make it simple for our discussion. Instant equity, $177,500. So the cool thing when this is a 4-bedroom, 2-bathroom home. As a side note, roof installed in 2017, new AC in 2018, new water heater in like 2013 or so. So this home does not have to have major cost things like usually AC and roofs are big costs on rehabs. Well, guess what? Doesn't need that. Needs a cleanup, needs some landscaping, needs some work on the inside to maybe do some reconfig and updating. But it's a nice situation. This can be a fix and flip, or it can be a rental. So that's how it's set up here. So this is what we were able to do. So start to approval. So start meaning going under contract with getting it listed, going under contract with the buyer, to the approval, which is when the lender says, okay, I approve your purchase price of $172,500. Let's get to closing, was 53 days. So I know a lot of people have lamented over the fact, and rightly so, because listen, me as anyone can tell you the experience in all this, that short sales can be a pain. They can be difficult. They can take a lot of time especially if you don't have a strategy or a plan or a process or really know what you're doing. People, so the group that I'm working with that purchased this, his last short sale they did with somebody else was over a year. And this basically is done in pretty much just over, we're talking a start to approval under 2 months, and they close it within 3 weeks once they got the approval. So pretty good case study going forward. But I just wanted to show you this to say, number one, this is possible. Number two, look at the numbers are there. Number three, when the housing mainstream story talks about, well, all the people who are facing foreclosure, they're simply going to put their properties in the market and people will buy them because there's so much equity that everything will be okay. Well, this does not follow the methodology, all right? Because don't forget, a lot of people who are facing foreclosure have other financial issues that are going on. So to get that premium price, which is that equity that's out there, you have to have a home that's going to be worth $375,000. Okay, so if the home was worth $375,000 and it was sold and they paid off their $340,000, yeah, closing cost commissions are pretty much breaking even now. But the home is not like that, because people who are in this situation can't spend money to remodel it. Homes typically, are either vacant, abandoned, or in physical distress. They don't take care of it, so it's not worth the premium dollar values that we have out there. So you see, now in certain locations, maybe in California, where there's a lot of equity, that could be changed. That might be possible, but I guess my point is, all that equity that's being touted as available is not really available. All right, it's almost on a case-by-case basis. But when you take a look at this, the longer this sits in the foreclosure process, it chips away at that equity. And then when you actually get to work on the deal, you look at what the property has or doesn't has, or what the shortcomings are, then that equity goes away. And don't forget, that's the assumption is you've put it on the MLS or the real estate agent. You're going to pay 5 or 6% commission, closing cost, tax prorations, whatever. So that number basically gets chipped away like everything. So the assumption that we have all this equity I think is very broad and may not be appropriate or accurate in a lot of stuff we're going to see in the new year. So again, this is just something. This is what we do. This is a great opportunity. There'll be more of these coming. We're working on. That's the thing. It's happening now. So I guess my point, everybody, is that we're getting deals. We're starting to put them in the pipeline now. We're starting to work on them. More are coming. More will come. We're going to be very aggressive when the new year hits because everything is fully opened up and people will be in the mindset. Expect the lenders. Lenders mean plaintiff lenders, people who are owed money. Once the new year hits, to start to go after this market, start to file these foreclosures on a much quicker, broader, quicker pace, more aggressive, the whole bit. So the fund's going to begin, early next year. Be prepared for it. But again, I just thought this was a great example. And yeah, I mean, of course, does this work? It works beautifully, right? Is this something I want to tout? You're going to see me talking about this as much as I possibly can. But the point is, it's possible, all right? And driving by, you would just go, oh, it's a reasonable house, so that's why you don't know what's on the inside, and you don't know the opportunities that exist right here. So why this is, I talk about two housing markets, is the fact that we're running the top market, which is the retail market, and no one's running the bottom market, which is shadow inventory. But when the two can converge, so if we made this converge, the opportunity to put a renter, like to do some cosmetic cash out refis. Well, if he can at 375, okay, and if that's the number, 80%, pretty good money to pull out. It's probably he'll pull his money out. So really, and he's going to have a renter in, and don't forget, we're triple the rent rates now. So you can see how this stuff can actually work to your advantage, getting the right property at the right price at the right time. So that's all I'm trying to say. I know I ramble, but anyway, that's a scoop. So again, this is a good thing. That's why you need to contact me to figure this stuff out. And if you're not doing it, you should be doing it. And the cool thing is too, this is the most recent number, so we don't have the November 2021 MSA for Tampa Bay where we are here, but I was able to beat the margin here. So obviously on a short sale, the margins were about 120K in equity, retail wise, 34% discount. We got almost a 49% discount and about 170 in equity there. So and that's being, I think that's being fair on the numbers. So I was able to beat that with how we do it in our process. So again, just letting you know, this is what you need to be looking at for opportunities in the near future. I've spoken quite a bit right now, so just connect with me if you want to talk about stuff. I'm going to be more aggressive about everything on a going forward basis because now's the time. So if you've been sitting on the sidelines past couple of years, like I have, this going forward is the time. It's make it or break it for the next wave of housing chaos. All right. So anyway, guys, appreciate your views, likes, and comments. Please share the video with your family and friends. If you're not subscribed, please subscribe, and look forward to speaking with you in a couple of days. And again, everybody have a safe and happy holiday season, and we'll look forward to talking to you in a few days.